Uh, Good morning. Are we in the afternoon already? Good afternoon, Leith. It's so nice to see you again for another episode of Leith and Catherine. We had to think of a name for our uh, podcasts each week. We will maybe we'll put it out to the crowd. And I did say a couple of weeks ago that I would take questions from people's comments, and I haven't actually done that yet. I look. The thing is I look at the comments each week, and I see that people have put questions, and I think, oh, they're good questions. We'll talk about those, and then I never get around to taking them, but we will do that. And I think next week we're hopefully going to have Cameron Murray join us as well. So maybe we'll work through some of the questions there. So if people do have questions that they want to put towards Leith or myself, if you value my opinion also, then you can put them in the comments. But Leith, we had Stardom last week because you just got back from Sydney and you put up your what happened on SBS Insight, and I have to say, I actually think you came across really well in that because you reeled all its information about population statistics that anybody that follows you regularly would have already heard. But I do think that it was quite impactful in the program itself.
Yeah, well, thanks for that. I mean, when I did it live, and I think I said last week, I found it pretty hard. I was really falling asleep, and I've been up for hours because you wake up. I wake up 6 a.m., start doing work, and then take a flight that takes like 5 hours by the time you leave home. And the whole recording didn't start until about 7 p.m. And I think it finished at about 9:30. So it was about a 2 hour thing, and it was really hot in there. And I remember just finding it really hard, and basically got asked about 5 questions, I think it was, over a 2.5 hour period. And yeah, when I did it, it didn't. Sometimes when you do these sorts of things in your head, you think, gee, that sounds crap. And because it doesn't feel like the words are coming out of your mouth properly. And I felt really slow in the brain, all that sort of stuff. But then when I watched it back, it was actually pretty good. Like all these, and to SBS's credit, they didn't edit me much. They only cut out a few things. Like there was, and they do that for time. But there was like, one bit where when some guy was saying how he was, why he switched to One Nation, and she came to me saying, Leith, is this, can you understand why? And I basically, what I said in the interview was that virtually every opinion poll in the last 10 years has shown that Australians want lower immigration, and even migrants in Australia want lower immigration. That's what and I think I said something like, and you can understand why the migrants want lower immigration, because the migrant areas, heavy areas like Western Melbourne, Western Sydney, are where areas that are getting crushed loaded the most. So they've got the fastest population growth. They're projected to continue having the fastest population growth, and they have the worst infrastructure. So as a result, migrant communities tend to not want more immigration as well. So I made that point in the thing, and then I said, voters have been ignored on immigration, which is why they've gone to One Nation, blah, 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 and they felt the impacts. So they cut that bit out, which was a bit annoying. But apart from that, everything else was basically as I said. But whenever you do live things, there's always stuff you wish you'd said afterwards.
Mm.
And in the question, when she said, can we have a debate about immigration without it reverting to racism? And I brought it back to the numbers, and I said that, 2000 was peak Australia, we had the Sydney Olympics, blah, blah. What I wish I'd said, and this is one of those things afterwards you go, I wish I'd said this. What I should have said is a simple, was Australia racist in the year 2000 when the Sydney Olympics were on? Because net overseas migration was only 110,000 that year, which is about 1/3 the current level. Right. So if talking about immigration numbers and wanting lower immigration means that Australia is racist, well, then Australia was racist in the Sydney Olympics, which is an absurd claim. And that's what I wish I'd said, something along those lines. But yeah, I mean, all the other stuff was good, and the numbers were good, and it's as good as I could have done, I guess, given the circumstances in a live interview when you don't know what you're going to be asked. So, and obviously there was no notes there. We're just sitting there and blah, blah, blah. So I've got to come from the top of my head. But that's the one thing I wish I could have changed, because I think that would have been a killer point. Um,
I encourage everyone to go back and watch it because it actually was quite impressive. But I think what was the funniest thing about it was the people's, because they pan to people's faces when you're talking. So we can see that the reaction from people that looked actually like they really had just woken up or they were about to fall asleep
oh, yeah,
was quite funny because they just all sort of were, I don't think they really quite knew how to take in what you were saying. So
yeah. And there was
quite,
another thing that kind of annoyed me about it. So this guy called Alan Gamlin, who's like the head of the um, this ANU's migration hub. So I call it the migration propaganda hub. He's an absolute shill for mass immigration shocking bloke. Just spouts propaganda, whatever. He did this minute and a half word salad of just gobbledygook on immigration that made no sense, right? And it was basically, I'm an expert, defer to authority because I'm an expert, and all you plebs don't know anything. That was basically his argument. And he made a whole bunch of crap claims in there that were wrong. And I was just wishing that the host came back to me, but it wasn't that sort of thing. It wasn't a debate. It was basically, she asked questions, you give an answer. So he followed what I said with some stuff that was absolute garbage. Like he said that, immigration boosts housing supply because migrants work in construction, which is actually categorically false. The data actually shows that the proportion of migrants that work in construction is significantly less than the Australian-born population. So what we're doing is we're bringing hundreds of thousands of people every year, and we're not boosting the supply side of the housing market because very few of them, a tiny proportion of migrants actually work in construction. And so what he said there was categorically false. And there was a few other falsehoods he made as well. But I wasn't allowed to challenge them, which was kind of annoying. So I was sort of chomping the bit for her to come back to me. And I was hoping that she would have gone, oh, Leith, and give him, and I would have just destroyed him. But I didn't get the chance. So there's a few annoying little things like that. But that just sort of show it wasn't a debate. It was like the host asked questions. And look, everyone in SBS was really nice. I can't say I was treated very well. They were all polite. Nobody treated me like a the great unwashed because I'm a proponent of lower immigration. There was none of that. They were all very good. So whereas I've got the opposite treatment often, well, not often, but previously in the ABC. Not ABC radio. Not like, I do ABC radio Brisbane and Upper Hunter Valley regularly, and they're really good. But the TV side in Melbourne, I've had some bad treatment from them, and they do treat you like you're the great unwashed. So yeah.
Yeah, I mean, having done quite a bit of television myself, it's heavily edited. I mean, I used to do the morning shows when on the Circle on Channel 10, and then
I
I've done
remember.
a lot of the project and sort of been on there and actually done a lot, interviews with the ABC. And what I would find with the ABC is well, even with anyone, whether it was the ABC or whether it was Domain or anyone that would call up, and want to have a comment or want to have an interview, the article was always had a slant on it. And even when I challenged the data, I remember ABC calling me and wanting to do a report on why the medium apartment prices had gone up quite significantly. This was just after COVID. And I challenged it and I said that the medium's actually wrong. You're looking at the median unit prices, which also accounts for townhouses and any subdivisions, not just apartments. And you're saying, why has it gone up bananas in Baldwin? Well, there's hardly any apartment blocks in Baldwin, you're looking at the wrong data, and you can't run with this data. You've got to go back to Cotality, Core Logic. Then you've got to ask them for specifically median prices for 2-bedroom apartments and one.
Yeah,
And
hedonic.
then you'll find that they really haven't gone up at all. He didn't do that. He ran the report on that, and they heavily edited my comments. And that was always what I found. We're sort of doing with the media, which is why I think now we've got YouTube and there's a lot more open discussion out there, which is why I think channels like this do so well, because people actually get to hear a whole plethora of information which they never would have heard previously. And actually that's why the success of macro business and has been sort of built on that, is the information that you give is really incredible, for cutting through a lot of the mainstream narrative, which is BS most of the time. But what we're going to get, before I'm going to launch back to you, and we're going to sort of talk about this for the next 45 minutes, is let's get into the data, because
Yeah.
GDP figures came out this week, and people are wondering what that means for inflation. We've discussed this a couple of times in previous weeks about, we're now on a interest hiking cycle. We're not expecting that to come down, and we'll also get into the fact that we've got war that's erupting in the Middle East. That's part of forecasts that I've been giving for quite a while, which is rising commodity prices, rising oil prices. So we can get into that, but that's certainly not going to be assisting inflation either. So what charts do you have for us this week?
Yeah. So I'll just quickly give a rundown. Hopefully this is all coming through.
Yep.
So yeah, basically we got the fourth quarter GDP, or national accounts it's called. So it's not just GDP, it's a whole bunch of stuff. But from the Australian Bureau of Statistics, that came in on Wednesday, and it was stronger than expected. So the headline number that everyone looks at is just real GDP, and what that basically is, it's real economic activity. in the economy. And the charts on the left, they're all from Alex John at IFM Investors, and he's basically plotted various figures against the Reserve Bank of Australia's latest forecast, and it's February statement of monetary policy. Now, the bottom two there, they're not from this release, but the top two are from this release. So real GDP came in at 0.8% for the quarter, which is, if you times that by 4, it's 3.2% growth. So it's pretty solid. Certainly stronger than we've had for a long time, and 2.6% annually. Now, some of that 2.6% annually was from backward revisions. So basically, they revised up some of the previous data from previous quarters. But even so, the 2.6% annual growth is significantly above what the RBA had forecast in its February statement of monetary policy. And you can see in that chart on the top left, it's got the orange line there, which basically shows the RBA's forecast. And it expected basically a weaker result and also real GDP to start trending down. And it's obviously running ahead of that. There was one fly in the ointment, though. That was that household consumption was actually significantly weaker than was forecast by the RBA, which was interesting because actually, and once you adjust for population growth, so I don't have that chart in here, but real per capita household consumption actually fell over the quarter marginally by 0.1%. So although overall GDP was strong, well, I wouldn't say it's strong, but strong given the current historical, the recent experience, and the fact that we've got a sort of slow, but for all the reasons I talked about last week with our low productivity growth and our speed limits, it's running above what the supply capacities of the economy. The household sector is actually not as strong, and consumption is not as strong. So that sort of does play a little bit against the RBA being overly concerned, because obviously interest rates impact the household sector the most. So if you want to try and pull down inflation, you're trying to whack the household sector. And if the household sector is actually, the consumption slowing anyway, and it's a lot weaker than expected, that kind of plays against this narrative a bit. But even so, the bottom two charts, we've got an unemployment rate of 4.1%. That's well below what the RBA forecast in the February statement of monetary policy. You've also got inflation, obviously, trim mean inflation, which is the one they look at. That's basically the headline inflation rate when they trim out the most volatile items to give you sort of like an underlying figure. That's running higher. That's 3.4% in January, which is, so it's above the top of the RBA's band at 3%. So all those factors would point to the likelihood of another interest rate hike. Now, the financial markets have actually upgraded their rate hike forecast, and that's the top chart on the top right. That comes from the ASX. This is basically the futures market pricing for the cash rate. And now it's tipping, the financial markets is tipping a small chance of a rate hike in March, but of basically 100% that we get one in May, which is, so got March is the next meeting this month, and then the next one after that's May, because they're now every 6 weeks. So they basically think we got 100% chance we're going to get another rate hike by May, and then basically 100% chance that we'll get another one again by the end of the year. So they're tipping 2 rate hikes this year. The 2 tables below that, I presented these last week. That just shows you the cumulative impact. So we've had 1 rate hike already, which has added $96 per month to the average, the cost of servicing the average first home buyer mortgage. And the average size of these mortgages comes from the latest ABS housing finance release. So that's for a new mortgage. If we get 3 of them, it's going to add $291 per month to the average new first home buyer mortgage. And for the overall mortgage market, so that's all mortgages together, you just average them out, basically $116 per rate hike per month. So if we get 3 of them, so I've already had 1 and we get 2 more, it'll add $350 per month. I talked about that last week. I won't go on too much about that. But so the bottom line is that this week's national accounts data, on the face of it, or it added to the weight of further rate hikes. Now, the bigger issue I'm concerned about is this war in the Middle East. So obviously the US and I think Israel did some joint strikes against Iran, and the Strait of Hormuz, which is basically, I think I pronounced that right, is this small passageway around the Middle East where basically a lot of oil and gas flows. and that's basically been shut
20% of
down.
the world's oil supply.
Yeah, that's right. That's right. So, yeah, a lot of the world's oil supply comes there, and also gas. Like Qatar's I think that provides about 20% of the world's seaborne gas.
Mm.
And they're the third biggest gas exporter. Almost, we're second, a smidgen behind us. So they're basically the equal second largest gas exporter in the world. They've basically shut down their gas transport, and there's oil obviously being disrupted. So all tankers aren't flowing and likely to spike oil prices. That's already started to happen. But if we get this protracted war, obviously oil prices are going to go up further, which means that the cost of transporting goods and also household budgets will go up as well, obviously, when you fill up your car, etc. But the cost of petrol, diesel will go up, and that just basically going to add cost throughout the whole logistics chain, because obviously diesel is used in basically every truck and every rail freight train, and also bunker fuel for ships and that sort of thing. So that means, higher cost of transport will be inflationary. And then the bigger issue, I think, for Australia, and this is because we've completely butchered our energy policy. So we can't really do much about the oil price. We're not a oil producer in Australia. We produce a tiny amount. So we import all our oil. So we're kind of, at the mercy of the world's markets there. But we have ginormous gas reserves and ginormous coal reserves. And particularly with gas, we're the world's second biggest gas exporter. But the east coast of Australia doesn't have a functioning east coast domestic gas reservation scheme. We're the only jurisdiction in the world that exports gas that doesn't have any requirement to supply Australians first. And as a result, the east coast, despite the fact that we export 75% of our gas on the east coast and primarily to China, every time there's a disruption like this, and we saw it during when Russia invaded Ukraine, our east coast gas price just rockets alongside the global price, which is moronic because we haven't decoupled our market from the world market. So that's kind of akin, if you think about it, given we're one of the world's biggest gas exporters, that'd be like a Saudi Arabian suddenly paying, $2 a litre plus for petrol at the Bowser, even though they're one of the biggest oil exporters in the world. It doesn't make a whole lot of sense. But because we've completely butchered our energy policy and haven't decoupled our supplies from the international market, and we haven't set a requirement to supply Australia first at a reasonable cost, we're going to experience soaring gas prices on the East Coast. West Coast has better reservation schemes, still not perfect, but they're more insulated. But here on the East Coast, we've got a separate gas market. And this just means that, like when Russia invaded Ukraine, the East Coast gas price is going to soar. Well, it could soar if this war carries on. And that means that if you're, say, a Victorian household going into winter and you rely on gas to heat your home, that's going to cost a lot more. More importantly, if you're a manufacturer and you need gas for your business, that's going to go up a lot, which means that's going to make you less competitive and you're going to potentially pass those costs on. Probably the biggest crunch is that gas is one of the key price setters of electricity in the wholesale energy market, because gas is used as the backstop and it's used for peaking. So gas often sets the marginal price in the wholesale electricity market. So when gas prices go up, wholesale electricity prices go up. So that will also be inflationary for electricity prices. So I call this the triple-headed energy monster that is bearing down on Australia. We're going to have higher petrol and diesel prices. We're going to have higher gas prices. And we're also then going to have higher electricity prices. And all this stuff is going to increase costs throughout the economy. It's called cost push inflation, when basically an external event pushes up the costs of inputs into the economy. And energy is used in every part of the supply chain, whether you're, a cafe who needs electricity for whatever, or, energy is fundamental to everything. And the cost of all that energy goes up. It's ultimately inflationary for the economy. And you get first and second round effects. So you get your first round effects when your bills come in, and they're more expensive. Then you get second round effects when businesses start to pass on those costs to recoup them. And then that starts coming through in broader prices. And that to me is the, bigger worry here. And, it's coming at a time, obviously, when inflation was already elevated and the RBA is already in a hiking bias. So there's a risk that they could, to bring inflation back within the band, they could potentially hike even harder, which will then has the risk of potentially throwing the economy into recession. So it's
Yeah,
not a great situation.
it's not a great situation, and I think that we sort of have to reminisce back to the 1970s peak because that was also caused by, the same geopolitical conflicts that centered on the Middle East and
Yep.
Iran, and triggered again supply fears and rising energy prices. I think in the 1970s cycle, well, I mean, oil prices. I think when OPEC did its oil embargo at that time, it sort of sent prices surging from around $3 per barrel to $12 within months. It was like a fourfold increase or something. We haven't quite seen that much.
No.
Yeah, I think prices that they would need to move above 120 to 140 per barrel to match the shock that occurred at the end of the 1970s cycle. But it's worth remembering, I mean, for anyone that follows cycles, that was the last peak of the Kondratiev cycle, which is the long wave commodity cycle, where you always get war at the peak of that cycle, incidentally. So we had war at the peak of that cycle as well, the Vietnam War, and quite a dramatic downturn that followed that. Because the 1970s downturn, I mean, it was really harsh, particularly in the commercial real estate property markets, real estate markets. So we would expect to see that again. But the one outlier, because I'm writing a report about this now for this week's Land Cycle Investor, and I was looking back at what that cycle did to Perth. And interestingly enough, after the downturn came in 1974, and it was, as I said, it was really dramatic. I think commercial real estate prices dropped around, gosh, anywhere from 40 to 60%, the median price of commercial real estate. I think it was harsher on the commercial market than it was on the residential real estate market. But even so, it was a dramatic real estate land-based led downturn. And there'd been an awful lot of development in the lead up as well. But Perth's real estate market actually performed quite strongly coming out of that because of the rise in commodity prices that was occurring over that period. So it will affect markets quite differently.
Yeah, and also Australia, I mean, it doesn't sound like we're very lucky here because we've butchered our policy to a large degree, but we are luckier than, say, if you're a UK or something like that, because UK is basically relying on, I'll just pick them out, but it could be Germany or whatever. You're basically relying on importing all your energy needs, and we're at least we will get some payback. So the federal government's going to get a lot more budget revenue because the higher commodity prices will. So I'm talking gas prices here, although it's bad for us because it'll spike gas prices. And yes, we don't collect enough rents from our gas exports. We will at least get some increased company tax receipts, and then that'll boost the federal budget. But it's not great. And to your point, in the 1970s, that was Australia's classic stagflationary period. So that's basically when you have low growth and high inflation. And Australia's kind of experiencing that sort of period again. We've got high inflation and pretty poor economic growth. So obviously this quarter rose, but if you look at the trend in the last sort of since the start of the pandemic, and in per capita terms, we've had incredibly poor, like our per capita GDP is still, I think, 1% below where it was at the peak so I think that was 2022 or something, or 2020. We're still 1% below that. So we've had this prolonged period of very poor per capita growth, but also we've got this stubbornly high inflation. So we're kind of in this stagflationary mess, not as bad as the 1970s yet, but if this war becomes protracted and we continue to have terrible productivity growth like we have, well, then we could just be stuck in another stagflationary trap where we've got this stubbornly high inflation, highish interest rates, but terrible growth. We haven't at least had the unemployment rates spike yet, but a lot of that's because, again, the national accounts showed that most of the growth in hours worked was in the non-market sector, which is basically the government-funded sector of the public service, healthcare and social systems. That's mostly related to the NDIS and education. So, again, most of the growth in the hours worked in the economy and most of the growth in overall jobs, and the reason why we have such low unemployment is mostly because the government spending has been generating most of the employment jobs and hours worked. So it's not particularly sustainable. It's not we don't have an underlyingly strong economy, which is driven by the private sector creating the jobs and hours worked and that sort of thing. It's mostly this sort of tax and spend from the federal government, which ultimately isn't a great situation, and certainly not helping our productivity.
Mm. Yeah, I mean, I think these things have they, as you're saying, they're happening on top of a fragile economy. So we've got rising costs, got rising interest rates, tightening of credit, and then you've got what's going on in the Middle East, which is very nerve-wracking for markets, and then rise in oil prices. I mean, it's the classic thing to push us into a recession. At this stage of the cycle, I can't see that how you couldn't really forecast that ahead. That must be what you're sort of figuring out in your own mind that we're heading towards.
Yeah, I mean, I definitely see the risks. I mean, it's always hard to know, when something's going to arrive and whatever. But I mean, I just think we're going to be in for a stagflationary period. So whether it's a recession or it's a
Well,
kind of slow grind we've had
um,
the last couple of years, I mean, certainly a per capita recession is definitely likely. I mean, we've we've been stuck more or less in one of those. We're out of it now, technically, but we've been in this sort of slow, low per capita growth zone for years, where we've just basically, and I wish I'd include the chart today, but I've got that chart I always do, which plots um, the immigration rate inverse. So I flipped it around, so down's up against per capita GDP and productivity growth, and basically our per capita GDP and productivity growth has been trending down for years as a migration rate's gone up, which it's not solely to do with migration, but yeah, we're in this. We're in basically a low growth rut economy with stubbornly high inflation. So
yeah.
yeah,
But
it's not good.
I mean, it's. I think the risks are is the amount of debt that's built up in the system. I mean,
Oh yeah,
it's not really showing on the bank's balance sheets as much as it is in the private credit sector. And if you look to what's going on in the US, I mean, you've had BlackRock that have had, significant problems with part of their lending arm. I can't remember the exact parameters of the story, but it's sort of coming out that they were lending to a company that had fabricated customers and lost a lot of money that way. I mean, these it's always about the cracks that are at the margins that start revealing themselves. And the reason I'm mentioning that is because just prior to doing this interview and podcast with you, I was interviewing Melody Wright, who I would push anybody who's watching this channel to go and look her up. She's absolutely brilliant. Her name is Melody Wright. She writes M3 Substack. Um, you will find her, and she's just as detailed when she talks about the market, and she is talking on the US market, and it's amazing how many resonances there are there with sort of what's going on here with their first home buyers, for example, can go and purchase a home with a 3% down rather than 5%
wow.
down, and have the same kind of system where they're pushing people into the market, and they have a lot of hidden vacancies, and a lot of risk in the system. And she is sort of saying this is the same conversation, wars breaking out in the Middle East. What is this going to do to inflation? How is this going to affect an already fragile economy? Because if America gets pushed into recession, then we're going into recession.
Yeah.
And
Well,
that's what she's seeing over there. And I think that if you remember sort of coming out of the 70s, I mean, we had stagflation, but oil prices surged towards the end of that decade. And the early 1980s recession was a very bad recession
oh,
as well
shocking.
that came out from that. I mean, it was went up to I think 11% unemployment, and then we came out of the early 1980s recession and banged into the 1990s recession, which was extremely bad as well. And then of course we've had the lucky period, and it does align with the Kondratiev cycle. Anybody that follows cycles, the Kondratiev cycle, it's around a 54-year cycle. You get roughly sort of 25 years up, 25 years down. On the upward wave of that cycle, you get sort of shorter recessions, a lot more sort of inflation and volatility, and then on the way down, it's the crashes can be very bad, and sort of reaching the peak of that cycle and coming to the down wave of it. That's sort of what we would expect on the other side of this if it plays out as I've been expecting. But it would be. I read an interesting article in. I don't know whether it was the Financial Review. Michael Bleeby, I think, had written it, where he was talking about what this would do to builders and property costs and housing costs. Have you looked into that with the?
No, but I mean, obviously, higher interest rates aren't great. So that adds to the cost of building, because obviously a lot of developers have to finance their builds, etc., and also puts down pressure, reduces the amount of demand for new homes, etc. But also, yeah, I mean, I don't know if this has a similar cost push inflation like what we got during the pandemic, where construction costs have gone up 40% since the start of the pandemic, and all the materials that go into housing, everything's gone up. If we get another nudge upwards in that stuff, God, it's going to be shocking, and especially given it's already too expensive to build homes at a price that most people can afford. That's just going to get worse. And to your point, I reckon we've got a whole bunch of perfect storm factors coming in. We've got this obviously the war stuff now and etc. But I've talked about it previously, but the AI bubble could burst at any time. I don't know how long that's got to run, but you mentioned BlackRock. Well, during the global financial crisis, when we had the subprime lending in the US, obviously there was all that dodgy subprime mortgage lending that went on, and a lot of that was done on the proviso that it doesn't matter if they default because we've got this collateralized debt that's worth a lot of money, and we can always just sell it off and get our money back. And that was the kind of assumption. And obviously that didn't hold up, and a lot of financial institutions went bust. But nowadays we've got a hell of a lot of lending into the AI sector, and what they're using as collateral, instead of using houses, they're using the GPUs, so the chips, that the NVIDIA chips, etc., that have been used to power this AI stuff. And they're assuming that if AI company X goes, I'm saying X, I shouldn't say X because that's Elon's one, but if this Joe Blow AI company goes bust and we've lent into it, we're secured by the GPUs that are the collateral, and we can just sell them and get our money back. The problem with it is that the GPUs, they lose value very quickly. So over about 3 years or something, they're basically not worth nearly what they were before, because they become out of date, they wear out, etc. And this whole notion that they've got this collateral securing all this lending is actually fake. It hasn't been tested yet. And there's a risk that there's a lot of leveraged lending in the AI sector that could ultimately be the next subprime type bubble burst. So we've got all these risks building all over the place, and you don't know when it's going to end or how it's going to end, or if they're all going to come a cropper at the same time and it ends in another GFC or whatever. But wars and the whole lot. But it's certainly a pretty worrying time, given the leverage debt build up and all the other headwinds that are converged, and the potential for a domino to fall somewhere to set off another domino.
Mm. Yeah, well, closer to home, the other thing that you've been looking at is migration patterns. And the joke has been, ever since the COVID lockdowns, and obviously we in Melbourne suffered that worse than anyone else. And I could talk for half an hour on the impact of being locked down during COVID,
9 months.
go out, the craziness that happened at that time, and
The amount of phone calls you and I had about this was, I was Catherine's counsellor for about a couple of times, and vice versa.
you were. I went I went right down the.
Yeah.
I went down the conspiracy hole and then
Oh,
right
not really that, but I
down.
mean, you were, but
I
I
mean,
remember.
I'm not averse to conspiracy theories, but I really went into the
But you were
whole.
trapped in your apartment, and
I
I
was
remember,
trapped. I was.
and,
I
and you and
was.
you couldn't even leave, because I
I
remember you. I
couldn't.
remember you said there was
That's
times
right.
it took you 2 hours to get down the lift because because the lifts were jammed. Remember?
They would only allow two people in
Yeah,
the lift at any one time, and then two of the lifts broke, and we would have to queue for an hour
yeah.
to get
So
into the
just to go
lift.
for your half an
And
hour walk, you had to
yeah, so
queue
you
up.
couldn't actually get, you were locked in and locked in, you couldn't get, and then there was this
I remember.
anxiety that if anyone in the apartment got COVID, of which two people did in the apartment building, of whether we were going to be locked into the apartments,
Oh,
and yeah, I did go slowly insane. I have to
I
take,
don't blame
I
you.
went for long periods
And it
without
was
seeing
during winter as well, a lot of this too.
anyone.
So it was just horrible. Like you couldn't get out. It was just stuck in a bloody apartment building. And if you wanted
Yeah,
to go out, it took you, it was a 2 hour logistical nightmare just to leave your
yeah.
building.
I went
Oh,
the moon's a luminary and that conspiracy theory down to the yeah it's actually it's interesting, and I laugh about it now. I sort of came out the other side, and
it did suck though.
have sort of rebalanced myself on the other side, but it was quite interesting how that what the impact of that had not just on the psychology of people in Melbourne, because I think we all sort of changed from that. I mean, your personality changed markedly from the start of it to the end of it, and good grief, I mean, it wasn't anywhere near as bad as what some people have to endure in life, but it was pretty full on through that period. But it was also what it did to the businesses, and it changed the whole atmosphere of Melbourne. And I still don't think the atmosphere is back, because right out of that, of course, then we've had the war between Israel and Hamas, and the mass protests that came from that, which took over the city, and then the synagogue bombings, and the bombings, I should say, the fire bombings of the synagogues, and the random violence that has happened, the machete attacks. I mean, everything about Melbourne has just been miserable, and it's become like the national joke that everybody, that no one wants to live in Melbourne, everyone's moving out. Who would want to
Yeah,
live in Melbourne? And the world's most livable city is no longer that. And I think we can all sort of relate to that a little bit. But your story, having gone through
yeah,
my lockdown trauma, is about people moving back to Melbourne.
yeah. Well, I mean, they
Another
could. So
heyday.
yeah, so I've just got some. So obviously, we got the February house price data was out. Got prop track on the left. That's the long term chart. Totality on the right. It's just the 28-day changes in property prices. But basically, according to prop track, there's a massive. We've got a 2-speed housing market, but especially you can look at the little blue line there at the bottom. Poor old Melbourne. Basically, zero price growth since December 2021 thereabouts. It's gone up 22%, I think, since March 2020. I'm not saying this is bad because I've got kids and I don't really care. I'd be happy if Melbourne doesn't go up because they're going to have to buy at some point and I'm going to have to help them. So it'd be better for me if the price doesn't go up and I'm not an investor. I don't care. I just live in this house. I'm going to live here for God knows how many years. So I don't care. But it is interesting. So Melbourne's dwelling prices since March 2020 have gone up by 22% according to PropTrack. Sydney's have gone up 46%, so double that. But the other three, I've mentioned this previously, Brisbane, Perth, and Adelaide have more than doubled in that time. So they've just gone up. They've rocketed. Melbourne has been right down the bottom. The high frequency data on the right from Cotality shows that Sydney and Melbourne are still lagging, and those three markets are still growing strong. If you look at it, on a 28-day basis. And my question here is, so Melbourne at the start of the pandemic was the second most expensive housing market in the country. So when Sydney, Melbourne, I can't remember who else, but Brisbane was really cheap. So now, and I've got these are the median prices from PropTrack in the table there.
Mm.
You can see that. I'm just going to move this so I can see it properly. Melbourne now has the cheapest dwelling values in the nation out of the major capital city markets. So it was only 854,000 the median dwelling price in February, according to PropTrack, versus the capital city median of just over $1 million. Now, what I've done there is I've shown the premiums in dollar terms and percentage terms between Sydney and between Sydney, Brisbane, and Melbourne. To Melbourne, and I've shown the other capitals, but let's just focus on Sydney and Brisbane at the moment because that's the East Coast markets. Mm-hmm. You can see that Sydney's dwelling value is $400,000 more than Melbourne, so nearly double. Brisbane is now $192,000 more than Melbourne. This is the dwelling value, not the median house or unit. I'm just looking at dwellings here. That's 22% more than Melbourne. So Melbourne's gone from being the second most expensive market start of the pandemic to the cheapest. Brisbane's gone from, I can't remember exactly where they were ranked at the start of the pandemic, but they were, very, very cheap. I mean, obviously, compared to Melbourne, very cheap. Now, Brisbane is the second most expensive housing market. And we're starting to see the latest migration data. Now, it's only to June 30 last year, so it's obviously pretty lagged. That's the chart on the left. This is showing interstate migration. So forget, it's not the overseas stuff. It's the movement between states and territories. And you can see that Brisbane's experienced a strong inflow for years, and it was particularly strong over the pandemic, whereas Melbourne experienced a huge outflow of people during the pandemic and in the months afterwards. And for the last 2 quarters, Melbourne's actually finally had an inflow of people. Now, it's not a lot. I think you add it up, it's like 1,000 people or something over the 2 quarters. So we're not talking a lot here, but it's gone from losing people to gaining people, whereas Brisbane's inflow is now the lowest it's been in like a decade. I think since 2016 when I looked at the data. So Brisbane's still getting people, but less. And the question here is, and Sydney's always lost people, but it's actually losing a bit less than it was. It's basically normal amounts. The question I've got is, given that Melbourne is so cheap now, and yes, we've got a lot of problems down here with all sorts of other stuff, but probably the worst state government in the country. There are a lot of faults down here, but one thing we do have now is cheap housing. And I mean, cheap housing. So here's the question. Are we now going to start to get people flowing south to Melbourne? Are they going to come down here to Mexico? Are we going to start seeing Queenslanders go, look, you know what? The hell with this. Too expensive. Can't afford. Brisbane's too expensive. I'm going to go down to Melbourne. The job prospects are still pretty good. Big city. There's a lot of diversity in employment, that sort of thing. Might as well go down to Brisbane. And we're going to start seeing Sydney-siders, although Sydney-siders start to say, you know what? Sydney's too expensive. Can't make a life here. I don't want to live in a shoebox apartment. I don't want to have to rent. I'm going to go down to Melbourne and, I can buy a house for the same price. That's the question here. I think at some point gravity has got to take hold, and we will start seeing migration south to Melbourne because Melbourne is now cheap relative to the others.
I think it's a fair point, because what you generally see is again, in the cycle that I forecast, you see Melbourne and Sydney kind of take off after a significant downturn. So we can look back to, after 2008, we had quite a bad downturn. Then Melbourne and Sydney took off between 2012 and 2017. We were talking about affordability problems here. And Adelaide and Perth and Brisbane, the median prices were going nowhere. And anybody that lives in those areas was wondering what people were talking about in terms of affordability, because their prices were really stagnated. And then after COVID, people moved out of Melbourne and Sydney and moved to those areas. And like you say, some of them are starting to look really frothy now. I think the thing that Melbourne's got going for it, particularly in light of our initial conversation about coming up to a potential recession, is that because prices haven't boomed as much as they normally do in Melbourne, we've really pretty much stagnated since the peak in 2022. We might not have such a significant downturn, because if prices aren't pulled down as significantly as we saw, for example, with Brisbane in the early 1990s recession. Brisbane weathered that much better than Melbourne. In the early 1990s recession, Melbourne had a mad amount of speculation in the lead up. I mean, 1989, the amount of building activity, development activity, commercial speculation and residential speculation that led to the 1989 boom, which actually was more dramatic than the COVID boom. When you look at the statistics. After that, that downturn hit Melbourne very dramatically, and there was a population exodus from Melbourne in the years that followed. And we were really struck quite badly with strikes in the city, and people that were around during that period of time. I was living in the UK during that period, but we're talking about how the cafes weren't open, and there was no trade and no population. Well, maybe it's flipped this time. Maybe when we have a downturn this time, Brisbane is going to come off quite hard because it's had so much speculation, and people would move back into Melbourne. It's got such a poor reputation at the moment. I think one of the things that's going against it is the amount of building activity now that's going into the apartment.
And a lot of that's migration based. So although the fact that we've got a lot of Australians are leaving or have left, I should say existing residents, we're still getting masses from overseas. So Melbourne's still growing very quickly. It's just that it's and I put the charts up. I don't have them with me this time, but I put the charts up last time, the deviation from the pre-pandemic trend, and it showed that Melbourne's the one market, the one of the major states which hasn't caught up anywhere near to its pre-pandemic trend in population growth. And that's because of this internal migration story where it lost this big bulge of people between, start of the pandemic to mid 2022. But it's still growing. And the official forecast from the Centre for Population is Melbourne's supposed to add 3.6 million people in the next 40 years, which is just crazy. So it's supposed to get to 9.1 million people, which, That's just crazy. But it's forecast to keep growing strong, and it's going to grow strong because of this overseas migration. So, but I think we're going to start getting flows of people down south here because the property is just too cheap to ignore. Now, if you want to start a young family and you want to have a house to live in, well, you're going to have a better chance in Melbourne now because it's just a lot more affordable. Like the median house price in Melbourne is just over $1 million. Now it's still absurd to say that, but it's about $200,000 cheaper than Brizzy, and $400,000 cheaper than Sydney. So, and such a big city, there are places obviously below median. You have quite a lot of choice there. It's so big. So, yeah. Anyway, it's something to look at. It's interesting, and we'll see how it goes.
I'm going to throw in a listener question here because I did make a note of some questions. I'm so sorry because I didn't make a note of who this question was from, but it kind of ties into it. And the question was, can we do a scenario where the immigration is halted within 5 years? What happens to the economy? And if it continues the way it's going, what happens to the economy?
Okay, so if it continues where it's going, we're going to have more of the same. So we're going to have very low productivity growth. We'll have headline growth, so the economy will grow. So, for example, if we run population growth of 1.5%, which is about its current level, which is still very strong, grow at 1.5%, you're going to get, on average, 1.5% GDP growth, right? Because more people means more outputs, which means more GDP. It's not the thing that matters, though, right? Per capita outcomes what matter. It's not how much you grow the pie, it's everyone's slice of the pie, but it's not even, GDP is not even a great measure. So in terms of livability, GDP is not a great measure at all. It doesn't count for how long you spend stuck in traffic congestion, whether you're forced to live at a shoebox apartment when your parents in the past could live in a house and you're forced to live in a shoebox apartment because there's so many people and it's crushed. GDP doesn't count for any of those livability stuff. But if we continue doing what we're doing, we're going to have more of the same. We're going to have capital shallowing. I mentioned that last week, whereby the population continues to grow faster than infrastructure, then business investment, and also the number of homes that we can build, which means that we're going to end up with less capital stock per person. And when you do that, you get less productivity growth. And you ultimately end up with lower living standards, right? So if we keep doing the same dumb things, we keep running population very high, and we continue to have capital shallowing, so the capital to labor ratio, the amount of capital, so tools, machinery, infrastructure, everything per person, shrinks on a per person basis, that's going to lower living standards. And ultimately, so we can have overall GDP growth because of population growth, but per capita growth is going to be poor. And the economy is ultimately going to be a low productivity, poorly performing economy, which doesn't improve living standards. If we significantly cut immigration, which is what we should do, go back to the early 2000s levels. Like I said, in the SBS thing, where we ran at about 110,000 that year. It doesn't have to be that low, but 130,000, for example. But we target it more towards the skills we actually need. So instead of going for lots of people, and a lot of them working in low quality jobs, and I'm not trying to denigrate people who do this, but we don't need more Uber drivers, right? We need more high skilled people in areas that we actually have genuine shortages. If we run a much smaller immigration program that is more targeted to the people that we need to fill genuine skill shortages, we'll have higher productivity growth. Both the average quality of the person coming in will be higher quality, so they'll give you more productivity growth. But also we're going to more likely to have capital deepening in, because the population isn't going to grow faster than the amount of business investment, the amount of infrastructure investment, and the number of homes you build. So, so that capital to labor ratio is more likely to rise when the labor side of it. So the capital's the amount of investment, that's the C, divided by the L is the number of workers. L is determined by immigration, predominantly, like population growth. If you, the problem we've had in Australia is the capital, the numerator has been poor, so the growth in that has been slow, but the growth in the denominator, which is labor, has been very fast. So the capital labor ratio has been falling. If we even just kept the capital the same, but we slowed the labor component, you're going to get the other way. It's going to improve, because even if we just keep the capital, we keep business investment, keep infrastructure investment, keep the number of homes that we build every year exactly the same. If you bring in less people in, you're sharing that expansion over fewer people, which means you get higher productivity growth. and you get
Yeah.
higher living standards. That's the
Yeah.
most basic way I can explain it. So you bring in fewer people that are better quality in areas that we actually need, more higher skilled in areas we actually need that get paid more. They'll pay more tax as well. And you also means that L, the denominator in the capital to labor ratio doesn't grow as fast, which means you get capital deepening.
Mm.
And that means you get higher productivity growth. And that's a pretty wonkish, nerdish sort of way to explain it. But that is it in a nutshell.
Mm. Mm.
And that means you'll ultimately end up with a better economy, even though the overall GDP growth, the pie won't grow as fast because you don't have as many people coming in to grow the pie. Everyone's slice of the pie will be bigger. And that's the thing that matters. It's the slice of the pie that matters. We could run an immigration program of theoretically 5 million people a year. If we just said borders, we have zero borders, anyone can come in. You're going to get people from everywhere. Like all these poor nations are just flood into the economy. You'll get more GDP out of that. But I guarantee you, everyone's slice of the pie is going to shrink.
Yeah.
And so it'll have a detrimental impact on the economy in a aggregate grow the pie sense, but it won't have a negative detrimental impact. It'll actually be positive in everyone's slice of the pie. And that's why we need to run a smaller and more targeted migration policy.
Yeah. Yeah, I mean, I think that the problem also inside of that is the whole mindset and the way that the taxation system and everything works needs to change because
Yep.
it's the conversation that we've had previously, which is the mindset at the moment is that the idea of investment and to grow wealth has been through things like
Non-productive.
that's right, investing in property and bumping up. And the only way that the price can continue to go up as rampantly as it does in property, and I think we've done a good way, a few demonstrations in the weeks that we've been doing this. The only way to get property prices to go upwards is to keep feeding demand into
Yep.
areas of limited supply. So when you get population growth going into cities, then that puts a squeeze on the amount of rental accommodation that is readily available at that time, and rents start to rise, and then that builds into the earnings of the land starting to rise, the property prices start to rise, and that kicks off the development cycle and everything else that flows alongside it. As soon as population starts moving out of the city, vacancy rates start to go up, and you see the whole cycle reverse itself. So it really is pinned on population growth. And I'm going to throw in another question here as well, because somebody put that, I don't have it written in front of me, but someone threw it in I think the first podcast that we did, questioning that scenario because of what happened during COVID and the population freeze, and yet we still saw rents rise and
Actually, we saw rents fall.
well,
But
we did initially, yeah, because of
yep.
the amount of short-term accommodation that went onto the market, but it was about prices going up also.
Yeah. So rents first. Rents fell initially, and then they did rebound before the immigration came back. They rebounded for two reasons. For starters, obviously, we were stuck at home, so people needed more space, so they moved out of group housing, etc. Secondly, the government was throwing money around into renters' pockets. Let's be honest, through its various stimulus policies, and that meant that people could pay higher rents. Right. So that was a bit artificial. But when rents really took off was when the borders opened, and they just went. And in 5 years, last 5 years, according to Cotality, 43% increase in rents. That so it's added about $10,600 to the annual cost of renting. So it's insane. Prices completely different. So I've always said, I don't know if I said it here or no, I said on Punters Politics podcast once. For me, when it comes to setting prices, I'd say immigration has like a 25% impact on prices. If you have to weight it, 25%. So it's there, it's decent, but then there's got interest rates, you got tax settings, you got all this other stuff, right? I could be wrong with that. Maybe it's closer to 40, but my point is when it comes to renting, I'd say it's like 75% because you can't borrow to rent. You don't. There's not tax policy doesn't affect it.
Yeah.
Leverage doesn't affect it. It's really a pure supply demand play, right?
Mm.
You work, you get money, you need a place to live. You compete against all these. The supply of rentals on the market's X, number of people's Y. Trying to get them, that pushes prices up. It's a supply demand market. So the rental market's where you have the biggest impact from rent from immigration. Now, as to why when immigration turned briefly negative during the pandemic and prices rocketed, well, that was pretty obvious. I mean, interest rates went down to 0.25%, right? And there was a lot of stimulus as well. So heaps of stimmies from the government. We got the lowest mortgage rates in the nation's history, and that obviously got poured into asset markets. Well, property, that's where most people spend it. So that drove up house prices even despite negative migration. But here's the thing. So I often use this argument against people go, oh, well, immigration doesn't impact it because when the pandemic came, immigration turned negative and prices went up. Well, guess what? When the RBA hiked rates by 4.25% to its peak in February last year, prices still went up. And they went up because we had record immigration. So we had more immigration than we've ever had in the nation's history. We had, in a 2.5 year period, we brought in 1 million people via net overseas migration. That's extraordinary. Never had that before. And so, yes, prices rose when interest rates went down to zero and immigration was negative. But then when interest rates jumped by 4.25%, the biggest hike in modern history, prices still surged. And that's because we had literally 2.5 million people flow in 1 million people flow in 2.5 years, or 1.2 million people in 3 years poured into the country. And that offset the massive tightening in mortgage rates. So the notion that migration doesn't impact house prices is wrong. It's not the only factor, but sure as hell does impact it. And that was shown during the pandemic when we had a record surge in mortgage rates. They went up like that, 4.25%, but we still had prices go up a lot because we had the biggest surge in migration in the nation's history, which offset the rise in mortgage rates. Now, the rental market is obvious. Rental market's just supply-demand market.
Yeah. I think also it's worth looking at migration patterns and what happened over that period during the pandemic. We didn't have so many people leaving the country, for one. And when the stimulus came through, people were throwing that into the real estate market. And this is the concept that land really takes the gains. Land is the only thing that we all need that is limited in accessible supply. And what I mean by accessible supply is land that is well facilitated with all the things that we need in order to live a full and vibrant life, so in a town centre and in a city area. But it's about what is available on the market at that very time when demand is increasing. And so when you're pushing money into people's bank accounts, you're not only giving them money to go and invest into the property markets, but you're also saw this surge of migration into regional areas where supply couldn't immediately lift to absorb that demand, areas where they'd never seen that much migration move into them. So it was these local migratory patterns that really impacted the market as well. And supply, it's not just about how much accommodation is built or constructed, it's about what is available at that very time in the market. This is one of the reasons why I always warn people about hotspot reports and so on and so forth that are based on what is relatively short-term data, because these things can turn on a dime. There's the amount of supply on the market, or vacancy rates, a small change in population growth statistics, or a small change in migration patterns, or maybe a local economy suffers, a regional economy suffers, for example, because one of the major employers shuts down and people start migrating out of the area. Suddenly it's not a hotspot anymore. So these things need to be looked at as well. But population growth, in all the studies that have really ever been done on real estate and all the academic studies, the cycle follows the same pattern, and you need to have demand flowing into areas that are limited in supply, which initially starts to put up the rents, and then everything else sort of flows on from that. But it will be interesting to see what happens to migration over the years ahead. I do feel that if we got a downturn, that people would migrate back to Melbourne's market if it wasn't as severely affected, because its prices haven't risen so dramatically as they have done.
Yeah, and I'll just add, so I'm going to try and remember it for next week, but Jared Minack, brilliant economist, used to be chief economist at Morgan Stanley. He runs his own advisory. He's done some absolute ripper charts. I think I put one up last week on the correlation between rents and population growth, and it was unbelievable. But he's also done another one globally with population growth and house prices globally. And it's incredibly strong correlation globally. And I'll try and dig that chart out. But yeah, to say that this stuff's, there's a lot of narratives by the fake economists in this country and, think tanks. I'd use a separate word for them if I didn't want to get demonetized. But they, they kind of spun this notion that there's only a supply side of the market. So the solution to everything is, I just got to build more homes. Like, it's a lack of supply. They never look at, because they don't want to talk about the immigration elephant. And the fact of the matter is, Australia's grown its population. I think it's I've often said it's the fastest in the advanced world. It's actually not true. It's the second fastest in the advanced world after Israel since the turn of the century.
Okay.
So since the start of this century, so end of 1999, Australia's population has grown by 47%, 9 million people, right? That is extraordinary growth. It is right at the top of advanced economies. Well, guess what? And in fact, the last 10 years, we've built more houses than we did the previous 10 years, or homes, I should say, not houses. So dwellings. So our construction rate has actually gone up.
Mm.
Problem is, it hasn't gone up as quickly as the population growth went up.
Mhm.
And as a result, we've got this, chronic shortfall of housing. And our construction rate is actually well above the other Anglo countries. It's actually pretty high in developed. If you do the number of homes we build per 100,000 population, it's actually very high. But the problem is that's like a static measure. But the problem is we're bringing people in a lot faster than these other countries. So we're swamping supply with population demand through immigration. So obviously the solution is it's got to be, yes, you can do what you want around the supply side. You go, we liberalize planning and all this sort of stuff. It's not going to do a whole lot, especially not in a short enough time frame to make a difference.
Mhm.
If we cut immigration like Canada and New Zealand have done, you will get an immediate impact, especially in the rental market, which is where the biggest impact is shown. And we've seen that where Canada has 16 consecutive months of declining rents. Its rents have fallen about 6.5% since the peak, since it's slashed its immigration. And Canadian rental affordability is now tracking its best in 6 years. And New Zealand has experienced similar when it's also cut immigration. So we've got two countries, the two most similar countries in the world to Australia, their economies and their housing markets are two examples that show without a shadow of doubt that if you run a very low immigration program, you're going to benefit the rental market and you're going to ease your housing shortage. I'll leave it at that.
Yeah, thank you so much, Leith. That was great. Next week, we're hopefully going to have Dr. Cameron Murray join us. We've done three-way conversations previously, and they've always been really exciting and popular and interesting. And Cameron, has done an enormous amount of research on the supply side of things, also on the energy side of things. He did a lot of research for us at Prosper Australia. It's been one of our employees there. So it's going to be a good conversation, I think. Anything else for you to add this week?
No, but I'm looking forward to speaking to Cam. I want to pick his brain on planning. So Cam did a really good podcast with a on the grounds planner in New South Wales. A guy does planning. He busted a lot of myths and something really worth talking about.
Yeah, on the zoning side of things.
Yeah, and this whole
Yeah,
notion that you can just upzone everything and everything's going to be hunky dory. Like this
yeah,
guy
yeah,
just like no,
yeah,
and and
yeah,
and and he made some point. We'll delve into it next week where he said that in New South Wales they approve something ridiculous, like 96% of development applications they approve. So
yeah,
this whole notion that they're acting as a roadblock is just BS. They actually rubber stamp almost everything.
yeah.
And anyway, it's Cam will explain it better than me because he knows this topic better than I do. I just merely watched his podcast and watched the interview with this guy, and it was interesting.
Yeah, so fresh economic thinking, if you want to Google ahead
Yep.
of time, is Cameron Murray. But
Yeah, it was
um,
posted about 2 weeks ago on
yes,
his
so yeah, on
website.
his Substack. That's on
Yeah.
Substack.
Oh,
So
it's also on his YouTube channel.
yeah,
I think I watched it on his YouTube channel.
or you can follow him on Twitter. He's got thousands more followers than we have on Twitter. He's
Yeah, I
far
don't. I
famous.
should get into Twitter actually. I've been very lazy, and I don't. Yeah, I don't mind. I find it a waste of time. Like I like it as a resource, but I just can't be
Yeah.
bothered responding to people. I've got so
I,
much.
I I dropped off it because it's the comments. I'm
It's a
too
cesspit.
fragile.
I don't care. I just don't have the time. I spend so much time. I spend so much time doing it on macro business. I don't have time to monitor something else.
Yeah,
I should do it. I should make the time, and like I barely even get enough time to respond to YouTube comments. So it's just I'm just time poor.
yeah. Yeah, no, I know the feeling. I try. I struggle with time as well. But if anyone is on X, I should say, rather than Twitter,
Oh,
it's
I'm
worth
always calling
following
it Twitter.
Cameron's tweets. He puts out quality content, so
Yeah,
he's good.
Cam and Tarek Brooker are like my two
Tarek,
favorite
yeah,
go-to economic guys and policy stuff, and my favorite data guy is Alex Joyner at IFM
yeah,
Investors. He's made that guy is brilliant,
yeah,
and he's like my favorite economist in the country on data and macro stuff.
yeah.
Those are the three guys I follow the most closely.
Yeah, which is exciting. So if you go to, so if anyone watching this does, it's inspired, give me a follow as well. You can give me a
Oh
link
yes, and
follow.
Catherine, of
So
course.
I'm CC underscore Cashmore or Land Cycle Investor. Go and follow Land Cycle Investor. And Leith, you are,
Don't bother about it on Twitter. I barely post. I just forward other people's stuff. But on YouTube, it's just type my name, Leith Van Onselen, or at
yes,
Leith Vo. You'll see it there. All I do
yeah,
there, I don't. All I do is I put up all my interviews. So this
all
stuff,
your interviews,
all
yeah.
my you know TV,
We're gonna
radio, blah
make
blah
it
blah.
more personal though. We're going to answer questions and we will have facts that people don't know about you. I haven't told you about this one yet, but we're going to open up that rabbit hole as well, so that people get to know you as a
Yeah,
person.
cool. All
You
right, bring it
behind
on.
you behind the you. Yeah. Anyway, we will draw it to a close for today, and we will reconvene next week with Cam, and that should be a good session. We can do the Leith behind the Leith and the Cam behind the Cam, and I can reveal some interesting information about you both, which
Yeah, sounds good.
might be interested in. Okay. All right. We all good?
Yep, all good.
Excellent. We will talk next week.
See ya.
See ya.